Okay, it looks like attendee numbers have stabilized now. So thanks again for everyone for joining us this afternoon. We're very pleased to be launching the latest webinar in TI's webinar collection. This one is a series we're planning to run every quarter from now on, and it's based on quarterly air and ocean freight rate trackers and outlook reports, which I'm sure some of you have been reading for some time now. And we'll really today be focusing on providing an outlook on the market. So looking ahead to how we think rates are going to be changing in the air and ocean freight markets, really with a view to helping you understand exactly how the market is changing and looking really to your purchasing strategies. When is the optimum time to be purchasing freight, to be putting contracts out to tender, and obviously helping you to understand whether you're paying the right kind of rates. But we'll really be focusing on future trends today. This session itself will last for about 45 minutes. There'll be 30 to 35 minutes of presentation as we take you through some of the key trends and content and our view as to where we see freight rates developing over the next year ahead, quarter by quarter. We'll have a Q&A session at the end, so there'll be a chance to ask any questions that you have outstanding at that point, and the Q&A option is available already. So if you'd like to submit any questions, please do enter that into the Q&A tool, and then at the end we'll work through as many of those questions as we possibly can. Obviously, as it seems always to be the case in both air and ocean freight at the moment, it's a very interesting time. We're just moving past a situation of market correction really in ocean freight rates. We seem to be moving into a period where rates have bottomed out again, volumes returning to levels we saw before the pandemic, and a look at sort of overcapacity in the market to some extent. So a bit of normalization there. On the air freight side, we're seeing a slightly different story. We've seen a big drop off from what we saw through the pandemic. But we are seeing rates creeping up gradually now, and we're looking ahead to how the summer period and the continuing return of passenger air travel is going to be affecting that. So those are a few of the issues we're going to be working through today as we try and map out the future for both of these transport markets. Right. I'm Michael Clover from TI, TI's Head of Commercial Development, and as many of you may know, TI is the leading source of market intelligence for the global logistics industry, and as part of that coverage we track very closely the air and ocean freight markets with regular data and reporting on the developments that we see there. I'm your host today, but I'm also joined by Nathaniel Donaldson. He's our data team leader and actually leads lots of our economic modelling work at TI, including the outlooks and forecasts for freight rates here. So thanks very much for joining us, Nathan. Hello.
Thank you. Nice to be here, everyone.
We're also joined by Vicky Kakarovska. Vicky leads TI's freight team and analysis for the air and ocean freight market, so is absolutely instrumental in a lot of the analysis that's provided today for both of the trackers. So thanks for joining us, Vicky.
Thanks for the introduction, Michael.
And we're also joined by Janan Hassan, who's another one of our economic analysts here at TI, who again has been instrumental in preparing a lot of the data for these reports and crunching the numbers. So she's here to share her insights as well. Thanks for joining us, Janan. Okay, so we'll move on. First of all, the first section is going to be covering the ocean freight market. So we're looking here at the overall situation in pricing development for the ocean freight market. And obviously this graph here from data built out of Freightos's coverage of the market really shows the story very starkly of what's happened over the course of the pandemic and the drop-off we've seen as well now. But Vicky, could you provide just a bit more insight on what's happened in the ocean freight market and where we are today?
Yes, of course, yeah. So overcapacity has been a big factor in the falling ocean freight rates. So that means the incredible amount of capacity that is being added to the industry right now through new ships continues to put downward pressure on freight rates. And in addition to this, port congestion, which has driven up rates over the past couple of years, is now easing across all major regions, and operational bottlenecks are reduced as a result of that. So this too contributes to the excess capacity that is currently available on the container market. And add to that the economic uncertainty and waning consumer confidence, especially in the US and Europe. And you have lower demand for ocean freight services to go with excess capacity, which is helping freight rates to bottom out.
Yes, thanks, Vicky. It has been a bit of a sort of perfect storm for ocean freight rates over the last year or so, as we've seen that decline come through. And obviously, we're also seeing from the shipping lines quite different strategies in terms of dealing with capacity. Some bringing on many new ships and others not. But it looks like that's going to continue to be an issue through the year, as well as those lower volumes too. But on the subject of volumes here, we'd just like to share with you, before we move on to the outlook sections, really some coverage of what's happening in different regions of the world in terms of volumes on different lanes, but also to look at the situation in capacity and other key metrics which help us understand what's going on in ocean freight. So this one is really a simple look at some of the major ports on the US West Coast, but we can obviously see that there's been a marked decline in many of their volumes in recent months. But Nathan, can you tell us a bit more about why that's happening and the effect that's had on rates?
Yeah, sure. So on this slide, as you mentioned, we do see it drop off. And actually from the ports that we've selected in Q4, the volumes were down 17.3% year on year. So really does reflect the fall in consumer spending, consumer confidence that we're seeing in the US data in Q4. But this is also West Coast ports, so I think it is clear that it also reflects the Trans-Pacific demand, and actually the demand for the consumer goods coming from the Asia-Pacific region is particularly low, even though we might not see the demand from the US economy looking as weak as these numbers suggest, so particularly affecting the Trans-Pacific lane.
Yeah, absolutely. And another key indicator really in this case, looking at the US market again, is looking at how much inventory there is as well. So this is quite an interesting one really for us, just to see, okay, well, what are we expecting to see if inventory levels are high? We'd expect to see lower levels of imports and lower sea freight volumes as well. So it's quite a nice predictor in the ocean freight market. But Nathan, obviously, as we've seen inventory levels, increasing again in the US market, what do you think the effect of that's likely to be?
Yeah, so again, reflecting that consumer confidence, and actually probably the rise in interest rates as well. So it's been discouraging that investment, both on the producer side, discouraging that investment and new inventory, and then the consumer side, that actually the demand's quite weak and it's not encouraging further investment, and the stock, and they're actually holding on to it at the moment. They can't get rid of it. So it's not showing evidence of immediate pressure that would push the rates up at the moment. And actually the November figure of 1.35 was the highest figure for nearly 2 years. So there's little pressure for US retailers to restock, and then we're not seeing a lot of demand side pressure on the ocean freight market.
That said, we have of course seen fairly strong US economy, hopefully strengthening, like most global economies over the course of this year, improving situation from a bit of a difficult situation, certainly through this last quarter. So we may see more demand, I suppose, coming in as consumers start spending again. And this, again, another nice comparison, really, this time not just looking at the US, but also looking at the European market, just showing the strength of the US. Any other insight on this one, Nathan?
Yeah, so a really interesting graph shows the picture on both sides, really. We can see that whilst the US has actually been quite strong since COVID, and the industry's recovered quite well, Europe's been really struggling and only exceeded 2019 average on a few occasions since the recovery from the pandemic. So US industrial output has remained above the 2019 levels since February 22. And this is the question mark, how this will actually affect the ocean rates. So we can probably see that it's going to put more pressure on transatlantic rates, where we've got the demand for those European intermediate goods. And actually maybe it's going to put less pressure on those Trans-Pacific rates, where US consumers and producers will be demanding domestic goods instead of those Asia-Pacific goods.
Absolutely. And obviously, I mean, when we're talking about ocean freight, it's always very interesting to look at the European and US markets from a consumption point of view. But obviously, we're looking at huge volumes on the Trans-Pacific or the Asia to Europe lane. So always key to, consider the situation in Asian ports as well. A big thing for this year is obviously we're expecting China to be properly reopening from COVID after restrictions eventually lifted. So we should see higher production volumes in Asia. But obviously that's not affecting the whole region, and it's a bit more complicated than that to see about how volumes will return in terms of the balance with consumption as well. This chart shows a nice trend up to sort of the end of last year. But can you tell us a bit about what you expect to see over the current period on that, Nathan?
Yeah, so it's quite a stable outlook for the Asia Pacific. We've seen that the volumes were up 0.4% year on year. When we're looking at some Chinese data for December and January. And then volumes are actually up 9.6% versus 2019. So it's a steady recovery, and we can probably expect that the new outlook for China with COVID will push the demand up even more. So a bit more added pressure from the stable situation we've seen so far.
Yeah, so that tells us a fair bit about the volume situation in the market at the moment. Another side of it, of course, we're talking about capacity on different lanes and how that is affecting the market as well. This one's looking at Far East to Europe data on capacity. Janan, could you give us a bit of a view as to what's happened on this lane?
Of course. So on this lane, Far East to Europe, the capacity has been recently cut by carriers, and that's because of falling demand. The capacity was at an all-time high in September last year, but it's since fallen slightly by 1.3%. This is usually just carriers canceling sailings to prevent rates from decreasing further as they adjust their supply capacity to the newly low demand. The downward pressure on rates due to capacity remains, but port congestion has eased and manufacturing on the head haul slowed down due to the Chinese New Year, and therefore freeing up more capacity.
Yeah, so a slightly more complicated picture there, as always. We'll return to some more direct capacity data in just a moment, but it's also returning to that point about the West Coast ports here. We're looking at not a direct measure, but obviously one of the big things that's happened over the last year has been the unwinding of that congestion in Port of LA. So you just talk us through this one as well, Janan.
Sure. So after 2 years of severe port congestion, it's starting to see relief. And this is mainly due to the normalization of US import levels after a high base year. The average wait times at the ports have been around 3 days in Q4, which is 80% actually below its average of 17 days in its peak in Q4 in the year before that. And it's also 30% below the start of Q4 in October.
Yeah, very much a relief, I suppose, to see that congestion and the queues of ships outside port as well, easing off. And obviously that's all the only other effects of that is the onward transportation for road transport has improved as well. So those bottlenecks are really being unsqueezed, as it were. So certainly improving the overall situation and efficiency within the ocean freight, but general transportation market as well. And then here we're really looking at the transatlantic situation in terms of capacity. Slightly different story to that which we've seen on from Asia. So take us through that one, Janan.
Oh, that's really interesting, actually. It's because the ocean carriers took capacity out of the Trans-Pacific lane and transformed it to the transatlantic lane because the rates are sliding at the fastest rate on the Pacific. This is just to take advantage of the comparatively higher rates. Thus, the transatlantic capacity grew 6% versus Q3. The new year also reduced capacity slightly with an average weekly capacity in January 2% below the previous quarter.
Yeah, so some of those seasonal factors still very prevalent there as well. Obviously, the scale of volume on this lane in some ships is much lower than on the Pacific or Asia to Europe lane as well. So you've also seen some ships being laid up there, of course, and sailings blanked. But obviously that tells us a bit of a picture about what's going on with capacity, always a bit more complex on different lanes. And that's why, you know, in the TI's reporting and on our data platform, we'll provide that more granular data on each of those areas for you to review. But we also have to look at some of the underlying costs as well. And obviously bunker fuel price is very important in that. Here we can see them shown and cost basically at in different regions around the world. Janan, if you could walk us through this one.
So globally, bunker fuel prices fell about 35% from their all-time high in May last year, and they've been on a downward trend since. The region that's above average is the Americas, and they remain the highest in comparison to other regions lately. But there's a downward trend there as well, and they fell 30% from July. On the other hand, though, Asia Pacific experienced the sharpest decline year on year by 16%, which was reflected in rates amongst other factors.
Yes, yeah, well, that's obviously one of the main issues we all look back to invasion of Ukraine and the impacts on fuel prices, but actually across different transport modes, we're now seeing some of that unwinding, though, you know, prices still relatively high versus historic levels. So still a real issue. Okay, well, now we'd like to come on to one of TI's ways really of helping us to predict what's going to happen in the ocean freight market. So actually for both air and the ocean freight markets, we provide these indexes which look at basic confidence in the market to help us show what people within the market think is going to happen in each transport mode. And Vicky, this is something that you've taken the lead on. So could you walk us through a bit more the sort of methodology and what this data shows us?
Yes, of course. So our sea freight confidence index is basically a quarterly assessment of the market conditions in the ocean freight market as reported by our survey participants. So that means that during each quarter, we survey shippers, ocean carriers and forwarders, and we ask them to share their expectations for ocean freight rates on various trade lanes for the upcoming quarter. And so far, we've had over 5,000 participants taking part in our poll. And over the previous quarter, over 400 participants took part in the ocean freight poll. And as you can see from the chart on this slide, TI's ocean freight sentiment index descended below zero, which reflects the industry view that rates will continue to fall in the coming 3 months. It also shows that the sentiment varies across the different trade lanes. For instance, the industry expects further falls on the transatlantic and Europe to East Asia trade lane in the coming 3 months. But on the Trans-Pacific lane, the growing expectation is that rate increases will moderate in the coming quarter. And the reason for this might be the fact that rates on this trade lane have already fallen back to pre-pandemic levels, which basically reduces the possibility for further rate falls in the coming months.
Yes, thanks, Vicky. And while I've been talking there, I just launched our in-webinar poll there on ocean freight rates as well, which it looks like everyone's used their initiative to respond to, but that's very much mirroring what you've been saying there, with 67% of respondents looking at you know, a kind of small increase of rates from this point out, and or remaining flat, next largest one there. Some predicting a more significant increase as well. So, you know, that sort of expectation that rates are sort of bottoming out now and coming forward is coming through from those results as well. So thanks very much for everyone's responses there. You know, see they're still changing, so a few more people coming through and adding their input into that as well. But it's really helpful to sort of see how the market itself is really expecting rates to develop in the coming quarters as well. Because from TI's perspective, we have our sort of pricing models and the predictions from that, which we'll take you through in just a moment. But obviously that's all based on the data, and it's such a market with many actors in it as well, that it's important to look at what the viewpoints are of those in the market as well. So I will just I'll end that poll now, but thanks for your participation in that one. And we'll move ahead to the next slide here, which is basically taking us through the global ocean freight rate outlook for Q1 2023. So as you can see, this goes basically quarter by quarter through the year and looks ahead to the next year, and we do this each quarter. Actually, in this case, this is just the global one, but we actually do this on a lane by lane basis through our Global Supply Chain Intelligence platform, which will give you this view, as well as a lot of the data that sits behind some of these different measures as well, to access that, so you can see exactly what's going on in each of these areas. But basically, this is part of our work to actually provide a forecast for freight rates here, and the team will integrate data from different metrics that are shown here, and then weight them to the overall output that we see. This is something that Nathan leads his team on, alongside our board of experts on the ocean freight rate market, to provide their guidance and input as well. And obviously, one thing I should say, just from a methodological point of view, is these arrows basically indicate the effect that each of these metrics will have on rates. So for instance, if we look at something like interest rates, obviously interest rates around the world have largely been going up lately, but we show an arrow pointing downwards to indicate a deflationary effect on rates. And basically the rationale for that would be that interest rates going up tends to suppress consumer demand and aggregate demand in the economy. That generally has the effect of suppressing volumes, and therefore suppressing freight rates as well. And that's why these arrows are sort of indicating the way that they are. So that's a useful thing to note when interpreting these charts. But Nathan, could you just take us through the sort of overall rationale for the prediction for rates that you can see along the bottom line of that particular table?
Yeah, sure. Thanks, Michael. So what we're showing here is still a downwards arrow for Q1. So what we're saying, that we still feel like there's room for rates to fall in Q1 of 23. Then we expect that the outlook will be quite stable for the rest of the year before an improved and more energetic economies throughout the world will push them back up in 2024. Now, the main reason for this this Q1 arrow is the fact that we are seeing that some lanes still have space to fall. We do provide this on a lane level in our publications on our GSCI, but we believe, especially the transatlantic lane, still has some space to fall, quite a considerable amount to fall, and we can expect to see that as we still have that low consumer confidence. We still have those high costs that's deterring investment and production, but we do expect that other factors, including increased production, improving consumer confidence, will actually settle it out, reduce that the pressure pulling it down, and then level it out for the rest of the year as we stabilize at a lower level.
Thanks, Nathan, and very interesting to see. So that's our growth trajectory really for rates over the course of this year. But I'd like also just to bring Vicky in on her perspective on some of the work on inventory levels as well, just to explain how we think that's likely to affect the rate development as well.
Yeah, so basically the volume decline that we've seen over the previous quarters was due to the process of inventory correction among retailers. But this process of inventory correction could last a couple of quarters and will continue to contribute to weaker volumes. However, it should be expected that once retailers get into the right inventory positioning and they start to replenish their warehouses, ocean freight volumes should pick up, and this cargo surge should stop the fall in rates. Obviously, under the condition that consumption holds up and recession is only mild.
Yes, thanks. Thanks for explaining, Vicky. And I think just to bring you in on, Janan, obviously we've spoken a bit about capacity and fuel prices as well, but in the context of this outlook, could you just tell us a bit more about the effect that you think those are going to be having on the sort of overall rate development we're going to see?
Of course. So regarding capacity, the existing capacity on all roads will add downward pressure on freight rates in the short term. However, in the long term, we'll see that self-regulate as carriers adjust to demand, lower their capacity. And for fuel, the Brent crude hit a 3-month low today, and the dollar is stronger and equities are weakening, which signals a looming decrease for crude oil prices. And crude oil prices are directly proportional to bunker prices, and this will be reflected in bunker prices in due time.
Thanks, Janan. Yes, so always interesting to see right up to the minute what's going on in the market there. So yes, a very complicated picture, of course, but good to give you a bit of direction as to where we're seeing the market moving. Now, our next section is really going to be covering air freight rates in a bit more detail and taking you through the same sort of idea as on the ocean freight side. Obviously, it's quite a different picture that we're seeing in air freight rates with a market that's already seen most of its drop off, and actually we're seeing minor increases again on the market. So Vicky, could you take us through this one?
Yes, so similar to the ocean freight market, in the air freight market, we are seeing a combination of weaker demand and increasing belly capacity. So during the COVID pandemic, the biggest challenge in the air freight market was securing capacity, which obviously pushed rates up. But this is no longer an issue on most of the trade lanes. And as a result of this, air freight rates are on a downward trend compared to last year. And in addition to this, demand for air freight services has also been affected by the gradual improvement in ocean freight reliability and the falling rates on the ocean side, which makes in turn air freight not as attractive as it once was. But it's still, we need to highlight that considering the exceptionally strong base in 2022, the current rate decrease we are seeing is not unreasonable, it's not unexpected. Instead, what we are witnessing now is normalization to more traditional levels of demand.
Yes, thanks, Vicky. Always important to have that sort of context available to you now. And obviously, we expect air freight, as usual, tends to be more responsive more quickly to changes in the economic situation as well. So that's always something to watch out for with the air freight situation too. And I think that's kind of, you can see that borne out really about how responsive to seasonal trends air freight tends to be as well. So in this case, we're going to take you through some of the volumes here. And this one's just showing airports for Asia. And Janan, can you give us a quick take on this one?
Of course. So the Asia Pacific route is still recovering from the pandemic and is currently being impacted by economic uncertainties globally. In Q4, the volumes at the 4 major airports averaged around 4% above Q3. On the other hand, year on year actually fell by 18%. Hong Kong International Airport, which is the busiest airport in the world, faced a cargo throughput drop of 16% year on year in Q4. Those declines we can attribute to China factory closures during the New Year holiday and the recurrence of COVID infection. And of course, on the backhaul, just low consumer demand and inflation.
Thanks, Janan. And looking again at some more airport volumes here, we're looking at US this time. So more of a consumption story, but how do you think this is affecting rates, Janan?
Demand in the US is slowing down, so the volumes are expected to decline further this quarter and the next. Air travel is seen to be gradually normalizing, and passenger traffic on this route specifically is rebounding, so it's a bit of a mixed bag.
Okay, and then in this case, this one has aggregated really volumes from across European airports, but another slightly different story here in the European markets. So how do you think about this one, Janan?
So our index dropped 4 percentage points year-on-year and month-on-month. And there's been a slight drop from 100 to 92 index points quarter-on-quarter. There was a recovery in 2021, but overall volumes in 2022 are still lower than pre-pandemic. The aviation history in Europe is still struggling to fully bounce back from the impact of the pandemic, even after the demand resurgence last year.
Thanks, Janan. Yes, so a slightly different picture really around the world in terms of that capacity development. One other thing we wanted to share with you, especially on the air freight side, really is as an indicator really of underlying growth. There's always a great story to be had from semiconductors, and obviously a market which has gone through a lot of turbulence lately in terms of massive demand, lots of factories having closures and difficult situations as well. But it's quite a good leading indicator of air freight demand, and you can see obviously a very strong picture there. What's also interesting is that we see lots of positivity and investment on the semiconductor sort of production side as well. So a strong bet from the industry that demand's going to be very high in the future as you look at the investments of sites and factories going to be brought on board towards the end of the year or next year as well. So that's really strong indicator of good prospects for the air freight markets in the medium to long term as well. And we now turn over more to sort of looking at how the max and mix of capacity and demand comes in. These next three charts are going to follow a similar sort of pattern. So Nathan, if you could maybe give us a bit of background as to how to interpret these charts and the data here, and then we can dive into the trend that they show.
Yeah, sure. So this is using IATA data and showing changes in capacity and demand indicated, well, the actual figures. And what we use here is ACTK, CTK, and ASK. So we've got ACTK, which is the available cargo tons kilometer, and that represents the available capacity in the air freight market, total available capacity. We've then got ASK, which is available seat kilometers, and this reflects the available capacity from the passenger market. That's really important because belly freight actually provides up to 50% of all air freight capacity sometimes. And then we've got CTK. Now this is the cargo ton kilometers, and this represents the actual demand in the air freight market. So the volume demanded and used by the customers of the carriers in the market. So here we are, and we actually show this year on year. So we do show you'll see a similar pattern in these graphs, maybe because of the effect of COVID. This is the year on year change of all those indicators. And here for the first one, we have the Asia Pacific region. So we've got a very clear effect of COVID, and then a rebound in quarter one and quarter two of 2021. But what we're showing really here, and what the key trend is here, is how the capacity really dropped more than the demand. So we've got the ACTK, the available capacity dropping more than the demand did. So this tightened the market, made supply tight, and then also the demand rebounded stronger than the capacity did. So throughout 2021, this pushed up rates as capacity tightened. But then what we've really seen is throughout 2022, and then especially more recently, we've seen that the available capacity has been growing faster, or even when it's falling, has been falling slower than the demand. So we're now heading into a place of surplus supply, which is allowing rates to fall, has eased the pressure on rates.
Thanks, Nathan. And would now take you over from the Asia situation, where we're expecting to see more demand rising as things open up even further into the European market, which has the starkest contrast there. So what's the current situation here, Nathan?
Yeah, so in this graph, we're actually using ASK, so that's the available seat kilometers to represent the available belly freight. So as Vicky mentioned, this was a really important factor. It really struggled with the market, and we can see that it dropped down severely. So we've got that big rise in 2021, which is the result of a low base from the start of the pandemic. But actually the CTK, which is the demand, was quite stable. So again, tightening that supply, the loss of the belly freight meant we really did struggle in the supply side. But CTK, the demand stayed quite steady. So then this caused a struggle, but we have seen ASK continue to recover. So the belly freight has continued to recover through 2022, and it's moved us into a situation of actual having surplus supply. And while the demand has been trending downwards, but we do see the ASK, the available belly freight, is now struggling again. So we do see that it's tightening again, and it is allowing more pressure for rates to tick upwards towards the end of 2022 and likely in the start of 23 as well.
Thanks, Nathan. And moving on to the Trans-Pacific routes, fairly similar story, I suppose, but would you highlight any differences for us?
Yeah, so again, this is a story of relatively stable demand throughout the pandemic, and then afterwards as well, seeing growth, and actually growth that was bigger than the drop-off of demand that we saw in the CTK. Whereas the belly freight struggled. We've got that high growth again, but it has stayed above and growing faster than CTK in 2022, providing that surplus and reducing the pressure. So similar story to Europe, really, when we're looking at the belly freight compared to the demand for the market, and it is easing the pressure.
Thanks, Nathan. Okay, well, really interesting. I mean, you know, obviously that mix of supply and demand is absolutely pivotal, really. But of course, other factors do, of course, have a role as well. And fuel, again, just like in ocean freight, very important. So here we have a price index for jet fuel, and you know, Janan, obviously, we've seen a bit of a decline here as well, though a bit more volatile. What do you think is the impact of this? Are we seeing this helping to lower rates?
Actually, quite the opposite from the bunker fuel prices, I'm afraid. It's because of shortages in jet fuel and distillates that we are expecting a higher spend on fuel in the upcoming quarters by airlines. So they have decreased overall by 18% versus last quarter. However, they increased 15% versus last month. The highest increase recorded is in North America with 32% increase. But the jet fuel inventories in the US and globally are running low.
So not good news from an air freight cost perspective there, unfortunately. Okay, well, let's move forward to the air freight confidence index. So working on a similar basis really to ocean freight, but Vicky, could you just confirm any major differences in the methodology, and then maybe talk us through what we're seeing from the data there? And in the meantime, I'll open up the poll on air freight rates for the participants.
Thanks, Michael. So yes, the air freight confidence index is very similar to the ocean freight index. The air freight index is a quarterly assessment of the market conditions in the air freight market. And this means that throughout the quarter, we survey airlines, forwarders and shippers, and ask them to share their expectations for air freight rates on various trade lanes. And over the past quarter, we've had over 1,500 participants taking part in the air freight poll. And the initial results from the first quarter of this year showed that a slight decrease in rates is now the most common response among the industry stakeholders that we've surveyed. And this basically suggests that the industry doesn't expect large rate falls in the upcoming period.
Thanks, Vicky. And in the poll, we're seeing that that's kind of reflected again, really, with the answers that there's the expectation around an increase, that freight rates would increase somewhat, or remain flat, or decrease somewhat. So relatively flat, but erring towards rates, increasing gradually, which I suppose is what we're seeing also alongside in our outlook grid as well when we look at the rates situation. So. Again, the sort of overall approach for this outlook grid is very similar to what we do for the ocean freight market, obviously taking account of very different data, very different factors. But you can see here that our expectation for this quarter as well is that prices will be increasing. But there's some quite complex dynamics at play in the air freight market as well. So Nathan, if you could just talk us through the overall sort of rate development path for air freight rates on a global basis, and then maybe we can look into what we see happening with some of these particular indicators as well.
Yeah, thank you, Michael. Yeah, so again, we're seeing with quarter one, we expect this space and there's evidence of rate rises. However, throughout the year, we do expect the situation to stabilize. So it's been very volatile recently. Combination of the effect of the capacity, the COVID pandemic, and then the industry having to adjust to that. And then also a big effect on consumer demand. So we saw COVID pandemic really adding that pressure in terms of that consumers wanting quick and fast goods, especially in the US. But we see this to level off, and we see it to normalize throughout the year, and we'll have less extreme pressure. And one thing to also mention, this one, as in with the last one, is a new edition of trade restriction, which we're considering in all of our trackers in both markets now. Especially we'll see it in the ocean freight, but in the air freight as well, is okay. We will show that this is also available by lane, and we'll show how this actually will affect rates on different lanes, which is a very different picture depending on which lane you're looking at.
Thanks, Nathan. So yeah, very interesting to think about really the impact of that restructuring of trades overall, referring to lots of the change we're seeing from a geopolitical point of view there. And obviously that's something which we're seeing a particularly pronounced effect on the Trans-Pacific lane, given US policy and the strength of that at the moment. So if you want to read more about that kind of issue, then that's where the lane-specific data available through GSCI and in the reports is worth taking a look at. Vicky, obviously capacity in air freight, particularly as passenger demand recovers and belly freight becomes more available, is a really key question. We've also seen some interest in the last couple of quarters from some of the big sort of express providers and laying up some of their aircraft as well. So there's a couple of counter indicators moving in different directions there, but could you take us through the expected pathway for capacity development over the next few quarters?
Yes, so you're right to say that belly cargo capacity is returning to the market, and this has been driven by the increased frequency of passenger flights. And with the start of the summer holiday schedule in the second quarter of this year, more belly capacity will be added to the market, and more belly capacity means a decline in load factors and rates falling. And as belly cargo space comes back to the market, some freighter capacity might be removed because the cost of operating the freighters no longer matches the market growth rate and demand.
Thanks, Vicky. Yes, and Janan, one other thing that's I think important to bear in mind here is the fuel prices, and you've already talked us through what's happening now, but the expectations here for rising fuel costs and therefore rising prices as well in terms of freight rates. But could you just give us a bit more insight on how that's going to play out over the next few quarters?
Like you previously pointed out, the fuel prices were driven upwards by sanctions against Russia, and low inventories have placed increased upwards supply side pressure on rates. But with China lifting domestic and international travel restriction, the global consumption is to rise even more sharply. and that will stretch the jet fuel price and supplies even further in the upcoming year.
Yes, thanks, Janan. It's very interesting to see also lots of those Chinese carriers increasing the number of flights they're making again now as things open up a bit further as well. So that's maybe another argument for increasing capacity in the market. Also, fuel consumption rising, therefore rising fuel prices too. Okay, well, we'll move on now to our Q&A session. We have overshot a little bit in our presentation there, so we'll try and deal with many questions as we can sort of quickly now. So thanks very much for all of those of you who have submitted questions to us, and I think we'll work our way through them now. So first one there is from Greg Nola. He is asking, is there any indication of when the Asia-Europe rates will bottom out? This is concerning ocean freight, I think. And a related question, will there be any restocking drive in Europe for retailers and consumer goods providers, considering the full warehouses and no demand? Will that happen this year? Well, that kind of talks to what you've mentioned on the inventory side, Vicky, but what would be your view on that question?
Yes, that's a good question, because restocking activity is a major driver of volumes. And even though the increased levels of excess inventory at the moment continue to contribute to weaker volumes, once the retailers start to replenish their warehouses, which is likely to happen towards the end of the second quarter and the beginning of the third quarter, volumes should increase and should stop the fall in rates. So yes, it's going to be towards the second quarter and the beginning of the third quarter of this year.
Thanks, Vicky. And then the next question is really more about well, it's how will the supply and demand outlook will be in the shipping market? Liners' capacity increased significantly and now demand is slowing. So how will liners manage this? Nathan, do you have a view on that capacity development you'd like to share?
Yeah, so I think what we see in the ocean freight market is that the liners will definitely react. And as Janan mentioned, they have the ability to react to changing demands with things such as blank sailings, shifting capacity into different lanes. So I would expect that liners will react accordingly. In terms of the supply and demand outlook, I think we can see that in areas where our volume, we see that there's falling demand, especially on the West Coast, the Trans-Pacific lane. I don't think this will continue to have, it will pull down rates any further. I think they have bottomed out. There's still room for rates to fall, for instance, on the transatlantic lane, particularly strong East Coast demand from the US and maybe European intermediate goods, so the liners will be able to react to that. So I think this will allow for further space and further rate falls on the transatlantic lane, as there's less pressure elsewhere, and the liners can move capacity there. So we should see that, again, the market will normalize and both supply and demand should be able to even out there.
Yeah, thanks, Nathan. And it's also interesting to look at the option with the third question as well. There's sort of looking a bit more at what will the liners do, and mentioning a sort of war on volumes. So obviously we've seen slightly different strategies now. We're still seeing a lot of spend from lines like MSC building out their order book and developing their fleet for the future. So very much looks like they're going after volumes and market share, even if they know that that may not be particularly profitable for them in the short term, to try and improve that market position. And I guess they're unable to do that by some of the huge profits from prior years, which they've been using. But on the question about ocean freight outlook, the grid was finalized a couple of weeks ago. That ocean freight report was published 2 weeks ago now. The air freight report was published on Friday. So fairly recent, but they're not taking account of those questions around things like the sort of banking sector, which you mentioned in that particular question. And on the air freight grid, asking questions about what's included there, things like demand. The sort of demand side factors there are included in areas like looking at, asking questions about the volumes, and that's included in terms of the metrics looking at overall demand from consumers, manufacturing output and production and that kind of thing. So that's how we would cover demand in those outlook grids, which are how we would cover that. Okay, so we're slightly overrun, so I think we'll complete the session there. But obviously, if you do have any remaining questions for TI, then please do feel free to get in touch with us. You can contact me using those contact details listed on that page. We'll always be happy to have a dialogue with you to answer any questions that you may have. And obviously, if you want more information about any of the data or insights shared today, we'll be very happy to to show you some more of the underlying data and TI's research. But aside from that, all that remains for me to do really is to thank you all for attending. Thanks very much for joining us in this first webinar on air and ocean freight rates. And thank you very much to my fellow panelists, Janan, Vicky and Nathan for their views today. And we hope to see you all together on the next one. And the last thing I'd just say is that the recording will be shared, so if you'd like to share that with anyone afterwards, you may do. And of course, you can also download the copies of the reports from the TI website if you'd like to access the air and ocean freight rate reports themselves. Okay, right, thanks very much for your time, and we hope to see you next time. Bye-bye.